Good morning, and you're watching Market Cafe on ET now with me, Vinny Motiwala. Along with me is Ankita Saxena as well. Very good morning to you, Ankita.
Very good morning to you, Vinny.
And Ankita, I don't think the global cues coming in, the handover coming in seems to be quite exciting.
It is not because COVID is back in China and it's clearly weighing in on the global markets as well. So stocks closed lower on Monday as social unrest from China's prolonged COVID restrictions weighed on the markets. The Dow Jones Industrial Average lost 497 points or was down 1.5% to end the day at 33,800. The S&P 500 also dropped 1.5% to end the day at 3,900, and the Nasdaq Composite also ended down 1.5% to close at 11,000 for the day. Now, Monday's sell-off was driven by demonstrations that broke out in mainland China over the weekend as people vented their frustration with Beijing's zero-COVID policy. Now, the US Treasury yield also pulled back yesterday. The benchmark 10-year Treasury yield was trading about 2 bips lower at 3.67%, so it's well below the 4% mark, and the yield on the 2-year Treasury note was trading at around 4.4% after falling by 3 basis points in the trade. Now, the European markets also closed lower on Monday. The Pan-European Stock 600 and CAC were both down 0.7% by the market close. DAX was down 1% in trade, and FTSE also closed down by 0.1% in trade. So that was the global handover that's coming in on the back of the protests that's going on in China. So for more updates on what happened globally, over to you, Vinny.
Absolutely. Let's move on and actually talk about Fed policymakers that stress that they will actually raise borrowing costs further to curb the inflation. Now, Lewis, who's the Fed president, St. Louis Fed President James Bullard, said that the Federal Reserve needs to raise interest rates quite a bit further and then hold them there throughout the next year as well and into 2024 as well. Once at the high enough level, rates would then have to stay there all during 2023 and 2024 is what he said. Now, even as we've seen Fed preparing for smaller rate hikes, the head of the European Central Bank said that she does not believe inflation has peaked after reaching the highest level on record. Now, ECB's President Christine Lagarde also told European lawmakers that the bank isn't through raising interest rates to combat those price spikes. Let's go across and listen in.
Higher interest rates will also have an immediate effect on people's and business expectations about future inflation, thereby guarding against the risk of second-round effects. Persistently high inflation could lead to de-anchored inflation expectations, which then become ingrained in wage negotiations and price settings. Not only would the resultant wage price spirals prove self-defeating in supporting real income economy-wide, but it would also hamper the productive capacity of the economy as a whole. Strong labour markets, with the unemployment rate still at the historically low level of 6.6% in September, are likely to support higher wages. Incoming data suggests that wages are picking up and we will continue to assess their implications for the medium-term inflation outlook, and that is referenced to in the first page of the document that we have sent you. So while monetary policy is geared towards bringing inflation back to our medium-term target, the economic outlook will also depend on the action taken by other stakeholders. In the current environment of high inflation, fiscal policy needs to be considerate not add to inflationary pressures. Fiscal support should therefore be targeted, temporary and tailored. It should be targeted so that the size of the fiscal impulse is limited and benefits those who need it most. It must be tailored so that it does not weaken incentives to cut energy demand, and temporary so that the fiscal impulse is not maintained longer than strictly necessary. At the same time, government should pursue fiscal policies that show they are committed to gradually bringing down their public debt ratio.
And moving on, Goldman Sachs expects Brent crude oil prices to average at $110 per barrel in 2023. It also remains constructive on gold and reiterated its 12-month price target for copper at $9,000 per ton and for aluminium at $2,750.
And update coming in, Elon Musk actually claimed that Apple has threatened to pull Twitter from its iOS app stores, a move that could be devastating to the company. Musk just acquired Twitter for around $44 billion. This underscored the immense power that Apple, the world's most valuable company, wields over the fate of the world's richest man, gamble on Twitter. Apple previously has revoked App Store privileges from companies that broke its security policies or hosted violence and other problematic content.
And Disney's chief executive officer Bob Iger said during his first town hall since returning to the company that he won't remove its hiring freeze as he reassesses its cost structure. It was Iger's first town hall with staff since Disney abruptly announced last week that he would replace Bob Chapek. He has been in the job for less than 3 years. Under Chapek, Disney faced criticism for its treatment of employees.
And Iran warns the US boosted from the World Cup after the US Soccer Federation removed the Islamic Republic's emblem from the Iranian flag and now deleted a social media post. The emblem was scrubbed from the US Soccer's post on Instagram, Facebook and Twitter over the weekend that promoted Tuesday's high-stake match between Iran and the US. Now, the US Soccer said that the emblem was removed to show support for the women in Iran fighting for basic human rights, according to CNN. The post was deleted after 24 hours.
And more trouble in the cryptoverse. The troubled crypto firm BlockFi has filed for bankruptcy in the US as the dramatic collapse of FTX continues to echo across the industry. The company had already halted most activity on its platform, citing significant exposure to FTX. BlockFi said it was seeking court protection to restructure, settle its debts, and recover money for investors. The company had also received a rescue deal from FTX earlier this year as the value of cryptocurrencies plunged.
And what we understand is that US is actually criticizing China's zero COVID policy. The White House has criticized Beijing's zero COVID strategy as ineffective and even said that Chinese people have a right to peaceful protest. Rare protests broke out against COVID lockdowns in Beijing, Shanghai and other cities over the weekend. Nearly 3 years after the virus first emerged in Wuhan, China is still imposing strict social controls to squash COVID outbreaks.
And in keeping with what's happening in China, with unprecedented protests against COVID lockdown and demands of Xi Jinping's resignation, China stays at one of the worst business and market confidence scenario. Now, here's a special report on what's happening in the country.
Slogans, placards, protests. These dramatic scenes are from China's Wuhan, barely a month after Xi Jinping won a historic third term as president. The angry protesters are demanding Xi's ouster, something that was considered unthinkable in the communist country only till last week. The simmering anger over arbitrary lockdowns erupted after at least 10 people died in a fire in Urumqi. Protesters believe rescue efforts were disrupted due to lockdown measures, though Chinese authorities have denied it. Student protests also broke out at the prestigious Tsinghua University in Beijing and the Communication University in Nanjiang. The protest against COVID lockdowns has spread from Shanghai to Beijing, even as China reported close to 40,000 COVID cases on Monday. Authorities are scrambling to contain the fresh surge in infections. The crackdown by the Chinese regime has already started. Protests are being pushed back, arrested or forcibly made to disrupt and disperse But the Communist Party's official mouthpiece, People's Daily, declared on Sunday that the government will continue to firmly adhere to the zero-COVID policy. The unprecedented protests are one of the biggest challenges to Xi Jinping's authority and the last thing the global economy needs in a deadly mix of political instability and economic uncertainty in the world's second biggest economy. Will Xi Jinping relent or the lockdown continue? The answer will have a huge ramification on investor wealth. With Boski Gupta, Adiraj Singh for ET Now.
Okay, on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more domestic news after this. Welcome back, and you're watching Market Cafe on ET Now. As promised, let's get more domestic. Let's talk about more domestic news now. Union Minister Nitin Gadkari has announced that all vehicles belonging to the Indian government that have completed 15 years will be scrapped, and a policy to that effect has been sent to the states as well. The scrappage policy, which came into effect in April this year, aims at phasing out unfit and polluting vehicles. Let's listen in to what the minister's plan is on the scrappage policy.
15 साल के बाद जो भी गाड़ियां होगी भारत सरकार की या भारत सरकार के उपक्रमों की, उनको सबको अपनी गाड़ियां स्क्रैप करनी पड़ेगी, वो चल नहीं पाएगी रोड पर। और अब मैंने शिवराज जी यही भारत सरकार की नीति को सभी राज्य सरकार को भेजा है कि वो भी अपने अंगीकृत कारपोरेशन में और सरकार में 15 साल पूरे किए हुए ट्रक, बसेस, कार सब वो स्क्रैप करें। और स्क्रैपिंग के यूनिट हर जिले में 2-2, 3-3, 4-4 खुलेंगे, जिससे रोजगार मिलेगा, देश का प्रदूषण कम होगा।
Right, and moving on, in an ET Now exclusive, Dinesh Kumar Khara, Chairman SBI, says a guidance of 12 to 14% is too conservative and sees no challenge in terms of capital and credit growth. Listen in to this slice of the conversation.
We clocked 20% growth. That was the busy season, and normally we have seen that the busy season and the normal activity, there is always a difference. So that is the reason why, on an average for the year as a whole, we expect that as against 20% in the busy season, we should be in a position to record about 14 to 16% kind of a growth.
But 12 to 14%, can I say is the conservative number?
It is because this is my philosophy: under promise and over deliver, and I would like to stick to that. But having said that, efforts are nowhere undermined ever. So whatever is the potential available, which is for the good for the stakeholder and also for the bank, would be more than happy to underwrite.
So hopefully FY24 we could be in for an upping of guidance.
Let's see.
I'd like to draw your attention to the deposit growth number. The deposits are growing at 10%, credit is growing at 20%, big gap of 10%. And if I look at for State Bank of India's balance sheet, the numbers will be even larger because of your balance sheet size. How are you planning to address it?
There are 2-3 things. We look at deposit as a franchise value, and at the point of time when there were not adequate opportunities available for deployment, we continued to carry on the deposit gathering mission of the bank, because that was perhaps the only secure option available for the depositors. So having done that, we had gathered a lot of deposit during the COVID period, and we deployed that money for investment into government securities or other such instruments which are available. We actually did the rupee dollar swap also and supported our international operations. So the cheap funds were available for supporting our international operations. So today, when the opportunities have emerged here in the country, we're in a position to unwind those rupee dollar swaps also, and that kind of money is also available for supporting our domestic balance sheet. Apart from that, we have got excess SLR, which is also almost to the tune of about 3.25 trillion to 3.50 trillion. So we will be unwinding that excess SLR also as and when there is a need for supporting the balance sheet. As of now, because our deposit base is significantly higher, it is about 40 trillion Indian rupees, and the domestic loan book is about 25 trillion. So even if that grows at about 10 trillion and here it grows by about 18-20%, so we still have enough, we can match the deposit with what we are lending. So I think overall I would say that as of now we have no challenge in terms of our capital, no challenge in terms of our inability to support the growth in credit. We are quite comfortably placed, and we have been increasing the interest rates in deposits also, depending upon our asset liability requirements, and also as I mentioned that we recognize deposit as a franchise value and we would like to be fair with our depositors as well.
And moving on, in an exclusive chat with ET Now, the Revenue Secretary Tarun Bajaj takes stock of the state of the economy. Now, he says that the capital gain tax would and should actually be aimed at less complexity and more tax parity. He also spoke about the GST Council discussion on online gaming. Let's go across and listen into this snippet.
What is your outlook? We might look at bringing some parity in the taxation part and simplicity of capital gains tax of all the three segments that we have?
We really need to simplify the tax structure. I don't even say that at that stage when I said this, I was looking for any extra revenues from this side. What I was looking was simplicity. It will reduce litigation. It will reduce the complexity, and people should be happy once they see that there are fewer buckets, fewer taxation, indexation is clear, there is a differentiation between financial assets and non-financial assets. So if you are able to do all that, that will help.
Right, and with that, it's time for us to slip into a short break. You don't go anywhere. There's lots more stock-specific action on the other side of this break.
Welcome back, and you're watching Market Cafe on ET Now. Let's just look at what the Asian markets are doing this morning. Seems like they've opened up a bit mixed in trade today because Kospi trading in the green with gains of around 1.8% in trade, while what we're seeing from Hang Seng also, that has also seen a good jump up coming in this morning as well. It's trading higher by more than 2% in trade as well. Now, in terms of when you look at Shanghai, not much of a gain coming in there in terms of just a 0.7% trend in terms of Shanghai. ASX 200 trading with a decline of around 0.8%, so that is the one to watch out for as well. While Nikkei is also trading with a decline of around 0.4% in trade. So mixed opening is what is coming in for the Asian markets. Yes, obviously the protests in China is what is keeping everyone on their toes as well, and seeing how this will actually work out, because a lot of supply chain issues actually turn out coming in from there as well. So yes, if COVID increases, what are the restrictions coming in? Everyone keeps an eye on that factor as well. Now, in terms of overall, let's look at what the commodities are doing this morning as well. We've seen oil prices actually slipping in trade again this morning. Not much of an action in terms of oil prices. WTI crude oil prices trading somewhere around the $77 per barrel mark as well, while Brent crude slight mild gains coming in over there, up 0.1% in trade almost, with gains trading somewhere around the $83 per barrel mark as well. So we have seen oil prices slipping in trade because of the China concerns coming in over there. The COVID concerns, China concerns in terms of demand from that China front is a factor that is keeping the oil prices a bit subdued in trade as well. Gold today, this morning, we're seeing a slight bit of a recovery actually coming in gold prices. Overnight we had seen a fall coming in. As of now, trading with gains of around 0.2% in trade. Gold prices somewhere around the $1,744 per ounce mark as well. Silver too seeing gains of around 0.6% in trade. So keep an eye out on that. Gold, silver seeing a bit of gain coming in this morning. SGX Nifty indicating a muted start for the Indian markets, as of now down almost 58 points in trade. That is 0.3%.
Right, thank you, Vinny, for that commodity and Asia market check. And we'll stick to Asian markets. Sean Reen, founder and MD, China Market Research Group, believes China's implementation of the zero COVID policy has been disastrous. Now, also adds that the next 3 to 6 months will be a struggle for China. Let's take a look on what he had to say.
So I've been in China for 25 years, and this is by far and away the worst consumer confidence and business confidence I've ever seen. And it's really because of the implementation of zero COVID. I think most people in China actually support zero COVID because it saves lives. The Chinese government should be credited for what they did in 2020 and 2021. But in 2022, the implementation has been a disaster. That's the only way you can word it. It's hurt mental health. It's hurt other health issues, and it's actually killed people because people can't get to hospitals, or as you saw in Xinjiang and the Ulamuchi fire, people couldn't get out of their homes. So consumer confidence is really bad. So I think investors need to think twice, or maybe even 3 or 4 times before investing in China right now. The next 3 to 6 months are going to be a real struggle because the government can't ease up on zero COVID without causing a lot of deaths. But they can't continue the current pace without causing a lot of lack of business confidence. So we're sort of in a very difficult conundrum right now. No matter what the government does, the economy is going to be weak for the next 3 to 6 months.
And obviously seems like it's an early Christmas on the Dalal Street, at least yesterday, but that too after a long wait of over 13 months. The Nifty and the Sensex and Nifty Bank touched their all-time highs, and we spoke to Aditya Shah, Chief Investment Officer at GST Investments, and Manish Singh, Chief Investment Officer at Crossbridge Capital. Let's listen in to what they had to say, what they think is the trajectory of the market going forward as well.
Even though the headline inflation in the US is still over 7%, but if you look at the high frequency data that is coming out, it clearly points out that those inflation numbers will come down very soon. I have been saying this for some time. I think that we are going to go back to this inflationary world sooner than people realized. When you're making investment decisions, you have to look at, does that economy has growth? And the simple answer is yes. And the economy has growth, and if you are ready to provide capital at a reasonable price, then the answer is yes, it's going to be a multi-year growth story. And the big challenge that the Western world has in many ways is that A, the growth is lacking, B, the indebtedness is extremely high, so you cannot just drive growth by debt alone.
We've seen the Indian economy continuing to be very strong. I think it is the strongest economy we have seen across the world. On top of it, the RBI has been able to really control the interest rates really well. And now we're seeing demand coming back in terms of credit growth, the leading indicator of growth growing in high double digits, as we've already interviewed the SBI chairman saying he will grow at double digits in the next 1 or 2 years. So what we are seeing right now is a very strong economy. On top of it, retail investors are piling on the money that they are. SIPs are touching a record high, which has never been before. India was an FII-driven market, and slowly we are moving towards a retail-oriented market where the mutual fund SIP flow continues to be strong, and it is holding up the markets. Stocks are not cheap here. However, there is growth, and that growth is nowhere seen across the world.
Moving on, Shankar Sharma thinks there are a lot of reasonably priced plays in the small cap space. And let's listen into his roadmap for the key themes to watch out for.
Yeah, it's unlimited opportunity. I'm inundated by all kinds of companies, transactions, and I don't think the market is expensive at all if you look wisely and look carefully. There are any number of fairly reasonably valued plays in the small cap space. I mean, I can easily see anything between 15 to 25 very decent opportunities, all within below 20 price earnings multiples for decent ROEs and decent cash flows. So I'm spoiled for choice. It's really like, I'm at a huge buffet table and I don't have enough appetite or even the wallet to be able to eat all of them. I mean, just fantastic time to be in the markets. So if you're asking me index level, I mean, that is fraught with danger and fraught with the risk of looking stupid. I'm just saying buy every dip from here on for the next several years in India. And that's, I think, the easiest way to understand this. Don't micromanage this relationship. Make this into a longer term relationship instead of it becoming one night stands.
On that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more individual stock names. What are the stocks to watch out for after this break? Welcome back, and you're watching Market Cafe on ET Now. And we have a full house in the studio today. First, let's bring on board Ashesha, Vamakshi, as well as Lisa in the studios. But Ashesha, I'm going to start first with you. What are the stocks to watch out for? What are the ones that one should be keeping on their radar this morning?
Good morning, everyone. So, Container Corporation of India will be the first one in focus in today's trading session. And this is because Government of India will be holding meeting on Concord divestment today. Meeting of evaluation subcommittee has been called to discuss expression of interest for Concord, and committee under DIPA may approve expression of interest for Concord today, on account of which Container Corporation of India will be in focus in today's trading session. Moving on to NBCC, where they've informed the exchanges they've won an order worth 272 crores from Amrapali Corporate Hub. So on account of this order win, NBCC India will also be in focus in today's trading session. Moving on to Lupin where Brazil, wholly owned subsidiary of the company, has signed a definitive agreement to acquire all rights to 9 medicines from BL Industria Octia Limited, a subsidiary of the company, on account of which Lupin will also be in focus today. Moving on to Union Bank where they said that they will be raising about 2,200 crores of tier 2 debt in 2 tranches, and this will be done on private placement basis. About 1,500 crores will be raised with a tenure of about 15 years, and the balance 700 crores will be raised with a tenure of about 10 years. On account of this fundraising that we have, Union Bank will also be in focus in today's trading session. Moving on to SBI Executive Committee of the Central Board will be considering raising of infrastructure bonds to the tune of 10,000 crores in the meeting that is scheduled to happen today. Lastly, we have 5-Star Business Finance. It got listed on the exchanges yesterday, and it reported its Q2 results, where reported net interest income came in at 301 crores, an uptick of 31% on a year-on-year basis. Profit after tax also saw a jump of 22% on a year-on-year basis, while assets under management stood at 5,700 crores, an uptick of 24% on a year-on-year basis. New debutant 5-Star Business will also be in focus in today's trading session.
All right, thank you so much for the details, Ashesha. Do watch out for the stocks in trade today. Moving on to Lisa. Lisa is here. So basically, Edelweiss came out with a note on, on a dealer check in the paints industry. Now they said that the demand during Diwali was below average, and there's a lot of growing competition in that space. So take us through the highlights.
Yes, so definitely paint companies is expected to be in focus today, as Edelweiss has come out with an industry channel check on paint dealers. So on demand, they say that the Diwali demand was a bit below average. However, the momentum post-September also has been weaker than expectation, and growth has been in single digit. But they're hoping that this is expected to improve going forward. On Grasim entry, they say that the industry has seen higher than average employee attrition, especially in the mid-level. And Grasim also can get aggressive in pricing. And they say that Grasim is expected to be on par or near Asian Paints. On Pidilite's paint foray, they say that they have not been too aggressive in the premium paints, but they are targeting a niche segment. Asian Paints also has not done as well on adhesives as they have done on some of its other diversifications. And on other peers like Axo and Kansai, they are playing catch up with the leaders in aggression, while JSW Paints has seen good traction in tier 2 cities.
Okay, Lisa, thank you so much for that update coming in on the paint sector. But Vamakshi, coming to you, what are the brokerages saying this morning?
Well, good morning to all of you. Let's first start off with Dalmia Bharat. Now, Jefferies has maintained a buy on this stock. They've in fact hiked the target price on this stock from 1,900 to 2,060. Now, here's why. They are also targeting industry-leading volume growth. They're also planning on seeing turnaround in the East region in profitability, which is a key positive for Dalmia Bharat. And with volume growth and cost leadership, Dalmia Bharat is in fact a very strong mid-cap cement play in Jefferies' opinion, which is why they've maintained a buy on this stock and hiked their target price from 1,900 to 2,060. Paytm is the next one on our radar. We have a report that is coming from CLSA. They've upgraded their rating on Paytm from sell to buy. They've also maintained a target price of 650 on this stock. They believe that the price correction that we saw recently warrants makes the risk reward favorable. Several investors are suggesting some discomfort or uncertainty on scaling up the lending business. They also think that on the back of this, the stock warrants a relook now. Cash burn should also end in another 4 to 6 quarters is what they believe, and continued selling by pre-IPO investors is definitely a key near-term risk. But despite that, CLSA has upgraded its rating on Paytm from sell to buy. And lastly, we also have the QSR space in focus. We have a note coming in from Phillip Capital. Now they've initiated a coverage on Devyani International with a neutral rating, target price of 190 per share, while on Sapphire they've initiated coverage with a buy rating with a target price of 1,825. Now they expect Yum franchises to see accelerated growth in the medium term. KFC, they believe, can see faster expansion. Pizza Hut, on the other hand, they believe is a highly underleveraged brand. So on the back of that, they believe that Devyani deserves higher valuation multiple than Sapphire. They've initiated coverage on Devyani with a neutral rating, while they've initiated coverage on Sapphire with a buy call.
Okay, Mamakshi, thank you so much for that update coming in on brokerages. But I'm going to pick up some cues coming in from Mamakshi and talk about the QSR space. One more person that is left and one more company that is left is Jubilant FoodWorks. Now, Phillip Capital has actually done a channel check which is suggesting that, you know, what Jubilant FoodWorks was doing, that they were actually testing some of their gourmet as well as premium pizzas in the last couple of months, at least in the Bangalore market. Now, finally, that is they've rolled out these pizzas pan-India basis. However, this is restricted to some selected outlets coming in only. So, in their view, what they believe is this is actually the third initiative that Jubilant FoodWorks has actually taken as a part of launch of the EDV for the economy range for products and regional initiatives that they have been taking over in the last few months. Now, this is mainly broad-based, as well as this will add to the product profile as well, product portfolio as well. And what Phillip Capital actually believes that, they are saying that this development is quite positive for Jubilant FoodWorks, as it will boost their SSSG growth, that's the same store sales growth, to some extent. And what they're doing, maintaining a neutral rating on Jubilant FoodWorks, target price of 615 rupees per share is what is the view coming in for Phillip Capital on the channel check for Jubilant FoodWorks.
And moving on from Jubilant FoodWorks to Sapphire Foods. Now, the company that operates brands like Pizza Hut, KFC and Taco Bell in the country. Now, Anisha Jain caught up with the group CEO Sanjay Purohit to discuss their expansion plans and more. Listen in.
There are two parts to our expansion. One is, I say that we had to have the license to grow, which means that is our new store economic model good enough to get us paybacks of 3 years at a store level? So if I look at 5-6 years ago, a Pizza Hut store would pay back in 7-8 years, which is really no payback. So we worked hard on this model, and as we've cracked the model and today paybacks are in the region of 3 years, we've started to expand significantly faster than we've done in the past. Where are the gaps that we see? So while new towns will certainly be a part of our expansion strategy, really the big joy would come in increasing density in the largest markets. So if you look at Mumbai, the principal competitor would have perhaps 3 or 4 times the number of stores that we have. So in many areas, accessibility of the brand itself is an issue. So while we will do new stores, the larger expansion will come from the bigger towns.
So Sanjay, since we are talking about expansion, is it going to be largely organic, or are you looking at the inorganic route as well?
So when we started off with this aspiration that can we be India's best restaurant operator. And that's the platform that we are trying to create. We are trying to create a full restaurant platform, which means that there should be growth opportunities available beyond KFC and Pizza Hut. We think KFC and Pizza Hut will itself give us multi-decade growth. But everything that we are setting up, especially our back-end processes, systems, is to be able to perhaps acquire a third brand and bolt it on. So most certainly, we are always looking at brands that we could acquire. I think we've articulated also clearly that what drives success in this restaurant space. And there are 7 mantras that we have, that we want success at scale. So we want a brand that can have the density of a Pizza Hut or a KFC in terms of number of stores. So the 7 mantras are quite simple. It has to be center of plate or habit forming.
Okay.
Difficult to cook at home. The processes must be independent of a chef. So we should be able to train you and me to be able to cook quite easily. The product or the production process has to have some IP or some distinguishing advantage that makes it very difficult to copy. We are squarely in the QSR space, and therefore value is very important. It has to be omni-channel. And finally, we are looking at a brand where we are not starting to build the business model from scratch. And therefore, it has to be an inorganic brand that already has some scale.
So is this something that we're likely to hear soon? Anything in the pipeline?
So like I said, we are always looking at brand opportunities, but it's too premature perhaps for me to talk about it today. But will there be a third brand in the medium-term future with all these conditions to be fulfilled? I would say yes.
Hello and welcome to this special conversation of CEO and by Sapphire Foods.
Anything that you expect from Pizza Hut, it has to taste fantastic. We have started to expand significantly faster than we have done in the past.
What's the success story that is going to be going forward, and what's going to be the recipe for the turnaround? Let's find out.
And moving on, India is the best story in the long term, believes Chris Wood of Jefferies. He notes that the Indian markets have been resilient amid uncertainty and continues to have major exposure in the country in his long term portfolio. Let's go across and listen in.
In recent weeks and months, India's valuation over China has reached unprecedented levels in terms of India having been remarkably resilient during this year of monetary tightening. When I say India, the stock market, whereas in China, we've had a lot of body blows. So tactically, there's definitely a good case to reduce India and add to China, and there has been for about the last month. But structurally, I still remain firmly of the view that India is the best story and a 10-year view in equities, in Asian emerging market equities.
All right, that was Chris Wood being positive on the India story. But with that, we're completely out of time on this show. Thank you so much for tuning in. You don't go anywhere. There's lots more action coming up on the market on the other side.